the multipliers are even larger than one, at least for the US. I know less about the international evidence, but what we tend to typically find is that government spending multipliers are larger on average in the short run, but tax multipliers are larger at longer horizons. So if you're thinking about spending versus taxes as a tool, we should expect to see their effects at different horizons. Even within government spending, if we look at government consumption versus government investment, government consumption seems to have short-run effects, whereas government investment seems to have long-run effects. So the multiplier for government investment tend to be larger at the long run, and the multipliers for government consumption seem to be larger in the short run. In the US Survey of Professional Forecasters, they forecast a lot of different variables of interest, including federal spending, 1 quarter ahead and 4 quarter ahead. And then there, the identifying assumption would be that if something is happening in the economy right now, the forecasters are going to incorporate all available information in their 1 quarter ahead forecast. And so then if federal spending is different from their forecast, that is really a surprise. That is, and so that can be our good instrument or the shock. And this has also become a popular approach. Arbach and Gorodnichenko, for instance, use these SPF forecast errors for US.
Welcome to the PIDE webinar. PIDE is the home of public policy and public policy solutions in Pakistan. We try and do this every day, every few days. We try and see if we can develop a conversation on issues relating to the economy and public policy in Pakistan. A conversation which is seriously fragmented and seriously lacking. So with that, let me introduce our speaker today, Sarah Zubairy, who is a professor in Texas A&M. And Sarah is going to present a subject that should be of deep interest to all Pakistanis: macroeconomics of fiscal deficits. I think we are probably a poster child for this subject. We've had no discipline throughout our history, and we promised not to do it for the future. But yet we have not suffered that many adverse macroeconomic consequences. So with that introduction, I'll turn it over to Sarah to educate us on what the macroeconomics of fiscal deficits are. Thank you, Sarah. Go ahead.
It's a great honor. Thank you so much for this opportunity. So I'm going to be talking about macroeconomic effects of fiscal policy. I worked on it mostly in the context of the US, and then towards the end, I'll try to bring it back to fiscal policy in the context of developing countries. So in advanced economies in the last few years, there's been this resurgence in studying fiscal policy effects. And part of it has been that because of interest rates at the zero lower bound, monetary policy as a stabilization tool has given them less room. And so countries around the world have relied more and more on fiscal policy as a stabilization tool. We saw that during the global financial crisis, and now we saw it recently during the COVID recession as well. Lots of creative use of fiscal policy tools to stabilize the economy in form of transfers with unemployment insurance or stimulus checks, or also on the supply side. In the US, they had the paycheck protection program so that to keep the business afloat. So, a lot of innovation on fiscal tools as a stabilization tool. So a lot of the discussion when we're trying to understand whether or not fiscal policy worked or what was its macroeconomic effect, it's summarized using if you're focused on government spending, it's summarized by this government spending multiplier. And it summarizes basically how much does output rise in response to a $1 increase in government spending. So is the multiplier $1? If the multiplier is 1, that means $1 increase in government spending raises GDP by $1. If it's less than 1, then GDP is going up by less than $1. What I'm going to be trying to trying to give you a big, broad sense of is how much does output increase in response to a temporary debt finance increase in government spending? Alternatively, what is the government spending multiplier? So we'll start off with just a very, very brief theoretical background that kind of lays down our expectations of what does theory predict. Then I will share with you some of the leading methodologies for estimating government spending multipliers. Then I will link it to some of my own personal work where we've looked at whether or not how effective government spending is a tool in stimulating the economy depends on the state of the economy, whether we're in a recession or an expansion. And it goes back to this old traditional Keynesian idea that you might get a bigger bang for the buck if there are many idle resources in the economy. And then lastly, I'll touch upon what does the international evidence say about the effects of macroeconomic effects of government spending. Okay, so for theory, some of the leading, you can think of the simplest models. Some of the leading models in macro are these neoclassical models, the real business cycle models, and new Keynesian models, which feature some level of price stickiness. And their predictions about what are the effects of government spending are not, in fact, that different. The main transmission mechanism is that whenever government spending goes up, people anticipate, well, at some point they need to be paid off with higher taxes. And so the primary effect is a negative wealth effect that raises labor supply and reduces consumption. So this is under the in a very simple model under these assumptions of a standard production function, where we're not assuming that, government is spending money on something that is actually productive that might enter the production function. And so essentially the multiplier depends crucially on how much time is spent working, because hours worked will increase output production. So then role of financing becomes very important. How is this government spending being financed? So in the context of models, we often start off by analyzing the effects under lump sum taxes so that every agent in the economy is paying the same amount of taxes. But then we also run into the result of Ricardian equivalence, which means that it doesn't matter if the government spending is financed by an increase in current taxes or deficit spending, because agents know eventually taxes will go up, and these are infinitely lived representative agents. And so if the taxes go up today, fine, they will adjust their hours. If the taxes will go up in the future, they will save that to pay taxes later. And so Ricardian equivalence holds. And so in this case, if there's a persistent increase, so not just financing, but the persistence of the shock matters. If there's a persistently high level of new government spending, that will lead to a larger increase in hours, because then the tax bill is also going to be larger. And then in this model, an increase in transfers has no effect, because a transfer will be one-to-one, just be taxed away in the future. If we introduce distortionary taxes in the model, then there is the negative wealth effect still that, taxes will go up. But distortionary taxes mean that you are paying taxes on the income you earn. So if it's labor income taxes, it's the labor income that you earn, it's a proportional tax to that. And so in that case, there will be this additional effect where your after-tax wage will go down, right, with an increase in distortionary taxes. So that creates an incentive for you to want to work less. So that'll put downward pressure on hours. So yes, there is the negative wealth effect, but on the other hand, your after-tax wage is lower, so you want to work less. And so then the time path of taxes will have a significant effect on the response of hours. If it's front-loaded taxes, then you'll work less as when government spending comes on board. And so, Ricardian equivalence is no longer going to hold. And in this case, government spending multipliers, the effectiveness of government spending on GDP is going to be much lower than the lump sum tax case. So I mean, I didn't show you any equations, but just a big overview summary of theoretical results on government spending multipliers, which kind of include the things that I just talked about, is that we expect low multipliers when there is a temporary increase in spending, and then or distortionary taxation-based financed government spending, or if we just, in our models, when we have these rational consumers. On the other hand, we expect higher multipliers when there's a persistent increase in spending, when we have lump sum taxes or deficit spending with future distortionary taxes, because distortionary taxes, it matters, the timing matters. So if it's deficit finance now, you can get a bigger stimulative effect in the short run. And then rule of thumb consumers just means that if you have a share of the economy that is liquidity constrained, then they basically just consume whenever, like their consumption is really tied to when the taxation occurs. So if taxation will occur much far away in the future and they're not taxed today, then they will raise their consumption, but they will lower it whenever the taxes arrive. So they are, rule of thumb consumers is another way that Ricardian equivalents can break down. And then monetary policy also matters. Like, what is happening with monetary policy? If it is non-accommodative monetary policy, you get low multipliers. If the monetary authority does not respond to any inflation created by increased government spending, then you can expect higher output effects. So this is what theory predicts. Now, where do the numbers lie when we go to the data? Because in the data, these are very clean models, but where do we stand? What does the empiric say? So in the next part, I'm going to be talking a little bit about how do we estimate, when we go to data, how do we estimate the effects of government spending on the economy, some of the challenges that we face, and then the different directions in which the literature has made serious progress. So, when you're trying to estimate the macroeconomic effects of government spending or taxes, fiscal policy in general, but I think this applies broadly to anything, monetary policy as well. Identification is a very serious issue. It's very difficult to measure these effects well, because usually what happens in data, what happens in real life is policy is responding to the state of the economy, right? So for instance, if we think about stimulus packages, they tend to be adopted when the economy is heading into a recession. So they're often based on these, whatever the policymakers are anticipating about the future economy. So if you just did some, put output on the left-hand side and G on the right-hand side, a simple statistical analysis, like you might just capture some correlation, and it might look that, oh, this stimulus is causing the recession, right? Because we're not capturing the causal effect, right? So identification, like how do we capture the exogenous change in the fiscal policy tool, exogenous with respect to the state of the economy? That's always a challenge. Ideally, what we would like to do, which is something that folks in in our department, we have a big experimental group, and so experimental economics group, and so they do run experiment. Ideally, as macroeconomists too, we would love to run just some experiment and then just get these numbers. IMF could run a randomized trial. Some countries are treatment, some are controls, some get an increase in government spendings, others don't. And then we basically compare their effects, and then we could see, okay, what was the effect of increased G in the treatment group versus the control group. But I mean, this is not how, with macro, we just are sort of, we just have the data that we have. So we must find natural experiments. So these are instances where fiscal policy changed in ways where it was not driven by the state of the economy. And we're stuck with whatever history gives us, right? So in macro, we're just using this time series data from different countries. And, lots of things were happening at the same time. You try to isolate, instances where you can make a credible case that fiscal policy was not responding directly to the state of the economy, then get their effect. And for that reason, like some of the things that I might show you today are about this big G, this government spending, right, which includes government consumption and government investment, because it's difficult to do for different components of government spending. So I won't be able to tell you based on whatever I'm going to be showing today, well, should I be spending more on education or spending more on health or spending more on, some other very specific subcomponents, because it's very hard in the data to get exogenous variation in these different components. But we take the first step of looking at government spending as a whole, and then maybe I'll tell you a little bit about some of the subcomponent findings that we have. Okay, and then once we have a good instrument, so then it's sort of similar to what applied micro does as well, right? We find some instrument. If we find a good instrument for an exogenous change in fiscal policy, we can then consider their effects on macroeconomic variables of interest. So the first, one of the very, in our literature, one of the leading approaches is this military news approach, where at least in the US, so I've worked mostly with US data. So in the US, most fluctuations in the US federal spending, you might be also surprised to learn, but most fluctuation in US federal spending is also due to defense spending. And so, for instance, this is total government spending from post-World War II in the US, and the big fluctuations, they are driven by defense spending. So this top panel shows defense spending. And these vertical lines are showing major defense related episodes. So this is the Korean War, this is the Vietnam War, this is the Carter-Reagan buildup around the time Soviet Union went into Afghanistan, and this is 9/11, okay? So from a macroeconomist perspective, this is interesting because most of these significant fluctuations in military spending are due to world military events. North Korea goes into South Korea. So it has nothing to do with the state of the economy in the US. So from that perspective, this is exogenous variation. And, for the US, you might not be able to necessarily do this for every country. For the US, you can do this because it's unique. It has not fought wars on its own soil. So there are no confounding factors like destruction of capital, that would, any confounding factors from there. So for identifying exogenous variation in federal spending, military events work really well. And so it is a very influential paper by Valerie Ramey in the QJE, where then she constructs this military news instrument, which is reading the newspapers that when some event happens, what do newspapers start reporting about what will happen with defense spending? And then this is a present discounted value of change in government spending as a % of GDP. And here, you can see the major events that you might think about, which are World War II, the drawdown in post-World War II. This is Korean War. And since this is % of GDP, you can see that all of the stuff that happened post 9/11 is actually not that large as a share of US GDP, but it goes on for a while, whatever, Iraq, Afghanistan, and so forth. And so then this becomes a good instrument to then study the effects of government spending. So you can just run a IV regression where you use this as the instrument for government spending, and then you can look at the effects of GDP. And so considering data from 1939 to 2008, this paper by Valerie Ramey finds the multiplier to be between 0.6 to 1.2, depending on which subsample she considers. What this is saying is that when there is $1 increase in government spending, GDP is going up by somewhere in the neighborhood of 1, slightly less or slightly above 1. Then another leading identification scheme used in the literature is a la Blanchard and Perotti, where they're using timing restrictions approach. So in their paper, they start by using quarterly data for US, and then this has been applied to countries around the world as well. They find no, with tax revenues, there is an automatic response to there's an automatic response of GDP to tax revenues, right? Whenever the economy is booming, for the same tax rate, tax revenues are just going to go up. So they also check for government spending, that whenever is there some automatic feedback and automatic stabilizer or automatic effect of economic activity on government spending, and they don't find a case for that. So at least in the US, unconditionally, government spending seems to be acyclical. And then the identifying assumption that they put in is that if you're using quarterly data within the same quarter, let's say the economy starts doing really badly, G cannot respond. Government spending cannot respond in the same quarter because there are all these legislative delays and implementation lags. So, politicians have to decide fiscal policy, right? So it's messy. In the US, the Senate and the House, they have to pass a bill. It's never going to happen in the same quarter, except it did in COVID, but usually it would not happen. And then, even if it does happen, implementation takes a while, right? So G actually showing up, the project actually starting, or that will take some time. So it wouldn't happen in the same quarter. And so, so that's their identifying assumption, that basically you can capture variation in G, which, by taking account of all the lags, but if you order government spending first, like in a VAR, and do a Cholesky decomposition, then you would get a government spending shock with this identifying assumption. And then considering data from 1960 to 1997, they find multipliers around 1. This approach has been applied, as I mentioned before, to other countries as well. And then another approach is, at the end of the day, we're always wanting to see a change in a fiscal variable that is not a function of the state of the economy. The previous approach that I mentioned, Blanchard and Perotti, has been criticized that there might be some anticipation effects. Another approach is to use survey of professional forecasters. In the US, survey of professional forecasters, they forecast a lot of different variables of interest, including federal spending, 1 quarter ahead and 4 quarter ahead. And then there, the identifying assumption would be that if something is happening in the economy right now, the forecasters are going to incorporate all available information in their 1 quarter ahead forecast. And so then if federal spending is different from their forecast, that is really a surprise. That is, and so that can be our good instrument or the shock. And this has also become a popular approach. Arbach and Gorodnichenko, for instance, use these SPF forecast errors for US, or they use OECD forecast errors for OECD countries. I had a student a few years ago, she was looking at government spending multipliers in China. And so she was looking at forecast errors from official sources and also from IMF forecasts versus realized spending in the data. And then there too, using this approach, they find multipliers, Ramey finds multipliers of less than 1. So less than 1 means $1 increase in government spending. GDP is going up by less than $1. Okay, so then, so these are on average over sample periods, the effects that we find, for long sample periods. I showed you some multipliers from 1939 to 2008. This previous one was from 1981 to 2008. So, I mean, these are on average for these sample periods. This is the average effect of government spending. One question that, especially since the Great Recession, the global financial crisis, that economists have been wondering about, and policymakers alike, is that maybe bad times are a particularly good time for government spending to play a role in stabilizing the economy. So this goes back, as I mentioned earlier as well, to this Keynesian notion that the government can be more effective in putting underutilized resources to use. And this goes back to the Great Depression, that there was a Great Depression, and then when World War II started, G went up and the unemployment rate went down. And so, it was a particularly good time maybe for government spending to go up. So the question is, does the state of the economy have an effect on the size of the government spending multiplier? So instead of these linear and average effects that we've looked at, if we were to look at, the effect in recessions versus expansion, good or bad times, would we find different multiplier numbers? So this is one area where I have done a great deal of work as well. So when you want to look at recessions and expansions, you want many episodes of that. And so the approach that I took with Valerie Ramey and Michael Aoyang was, then you want more data. So one way to get more data is to have more cross-sectional data. In our case, what we were doing was having more time series data. And so we constructed quarterly data for the US starting in 1889. And so then you have lots of periods of high and low unemployment, high and low government spending. And so you exploit that information to see if the responses are different during good versus bad times. So if you have any graduate students in the audience, I just wanted to show one equation really to help you understand that we're not doing anything super complicated. The complicated part, I think, is coming up with the instrument. But once you have a good instrument, so in this case, we were using the military news variable, which Valerie then extended further back into time, we're just basically running a regression. So here we have the output variable that of our interest, of GDP, and we're regressing it on government spending. We have a bunch of controls, so that includes lags of GDP, lags of government spending. If we want to account for financing, we might put in lags of taxes as well. And then we are basically running a nonlinear regression in the sense of we want to see if the effects are different in recession versus expansion. And so here we have a dummy variable that takes the value of 1 when we are in good times, and a value of 0 otherwise, and this takes a value of 1 when we are in bad times, in a recession. And then these coefficients basically are giving us, I'm interested in the multipliers, which is the cumulative effect of output over the cumulative effect of government spending, so that's why I'm using these sums. But these coefficients then give me the multiplier. So when H is 0, this is just GDP, I'm regressing it on government spending and a bunch of lags. And this government spending, I'm using an instrument for this government spending, which is my source of exogenous variations in the case of military news. And then this coefficient is just giving me the multiplier. So identification, we use, our baseline was using this military news variable, extending Ramey's 2011 paper. And then we also use both, then you can use this framework will help you use as many instruments that are available to you. So we use both military news and the Blanchard and Perotti identification. Then what are good times or bad times? For this long period, the measure of underutilized resources that we have is unemployment rate. So we look at high and low unemployment periods. And so, the military news, I showed you this variable before as well, and we will go further back in time. So now we have World War I in there as well. And these decreases are things like, Berlin Wall falling down, so Cold War ends. So, we have a lot of, this is our instrument, and we have a lot of variation there of increase and decrease, and this is our unemployment rate. And so here, this is the Great Depression, and this is the global financial crisis. So we are exploiting this variation in long time series data. So what do we find? So for this really long time period, if we look at our linear model, so if I didn't have those dummies, if I was just running a linear regression, we get multipliers of 0.66 or 0.71, depending on the horizon. So again, less than 1. And then when we divide it into high and low unemployment periods, we also don't find any difference. So it's around 0.6 or 0.7 in both high and low unemployment. We don't find any evidence. With another identification, we find slightly larger multipliers in high unemployment state, but they're less than 1 across both states. So we don't find evidence that, oh, in a recession, you'll get a bigger bang for the buck overall for the US. Then in very recent work, we were thinking about whether maybe the type of recession matters. And this is a discussion that was going on during COVID as well, right? Because there were these demand forces at work, but then there were these demand forces at work in the sense that in the US, at least, they send out a lot of stimulus checks, but households could not really go to the stores, but then do we expect their demand to rise or not? But on the other hand, there are all these supply chain disruptions. So we know there's a lot of supply shocks at play. And so we developed a model, and the model suggests that government spending should have larger effects in demand-driven recessions than supply-driven recessions. It is a demand-driven policy. It's supposed to increase demand, and so it is more effective in demand-driven recessions than supply-driven recessions. So we take this theoretical hypothesis and we test this in data. This is joint work with one of my colleagues here at Texas A&M, Yunjo. And then we slice the data further. So because we have this long time series data with my work with Valerie, we can slice the data further and distinguish between the different types of recessions, demand-driven recession and supply-driven recession. That's really hard to do. How would you do that unless you have some structural model? So our first pass is that we're distinguishing between high and low inflation unemployment. So we know that supply shocks cause, demand shocks cause a co-movement in prices and quantities, and supply shock prices and quantities move in the opposite direction. Or vice versa, yeah? So we have prices, that's right. Prices and quantities move in opposite direction in supply. So here we just have high unemployment, right? So it's not output. So this is low output and high inflation, so high unemployment and high inflation. And then demand-driven recession is high unemployment and low inflation. And again, we use these leading methodologies for identifying government spending shocks. And we find significantly larger multipliers in a demand-driven recession, around 1, and close to 0.2 in supply-driven recessions, which seems to suggest that when we are deciding to use a specific policy tool, it is also important to try to disentangle what is causing the recession that we're in. And so maybe in a particular type of recession, this tool might be a more effective tool. So in a demand-driven recession, government spending can be an effective tool in stimulating output. On the other hand, as far as expansions go, we find no evidence of multipliers differing based on inflation in a low unemployment state. If you look at low unemployment, low inflation, or low unemployment, high inflation, there seems to be no difference in the output effects of government spending. So this has been very US-centric, and I apologize, but this is sort of the area that I've worked in as well. So now let's see what do we know about government spending multipliers when we look at international data. So one of the leading studies there is this paper by Ilzetsky, Mendoza, and Wade. You know, one of the challenges always is good data, right? And in the US, we're lucky we have very good data, and then it makes answering questions much easier. So one of the big contribution of Ilzetsky, Mendoza, and Wade was because this Blanchard and Perotti identification is so tied to this quarterly data, you might not be able to make the same arguments about identification with annual data, that within the same year, a government cannot respond to the state of the economy. A year is a long enough time that, maybe that's not a reasonable assumption. So they wanted quarterly data. And so a big contribution there was that they collected quarterly data on 44 countries, where they have 20 high-income countries. So that includes US and, just the usual candidates, UK, Canada, a bunch of European countries. They have 24 developing countries. I checked, and Pakistan was not in there. It was mostly Lithuania, Latvia, those sorts of countries. And the data starts as early as 1960, as late as 2007. So it's not a balanced panel. And they're using, going back to sources to get at quarterly data. And that's one of their big contributions. Another thing that they do is, because there's so much heterogeneity across their data set, is they analyze how various factors such as level of development, exchange rate regimes, and so forth affect the multipliers. So this is the main highlight of their results. These figures are showing multipliers for the high-income countries on this side and developing countries here. And what they find is, so when there is a 1% increase in, 1% of GDP increase in government spending, in high-income countries, they find that on impact, the multiplier is about 0.39, so 0.4, and it's about 0.6. So it's less than 1, but it's between this range of 0.4, 0.6 for high-income countries. On the other hand, when they look at developing countries, it's maybe barely positive on impact, but the long-run effect is negative. So they find a multiplier of minus 0.63 in the long run. So there seems to be a big difference between developed and developing countries. So multipliers are positive in industrialized countries and negative in developing countries. Then they look at further cuts. So cutting the data along different dimensions, not just level of development. They find that if you have a fixed exchange rate regimes, the multipliers are above 1, while flexible exchange rate regimes have negative multipliers. And this is sort of related to what we'd found in the theory about the role of monetary policy. And so in this case, it also seems that monetary accommodation is key to the size of the multiplier. So, if you are considering a closed economy, if you have interest rates at the zero lower bound, you seem to have large multipliers. And in this case, with these open economies, fixed exchange rate regimes, the multiplier seems to be larger than with flexible regimes. Then they also look at countries with their level of trade. So openness to trade, they measure as trade as a ratio, imports and exports as a ratio of GDP to classify countries as being open or closed to trade. So for instance, US would look like it's closed to trade because it's not a very large share, but with a small open economy, it might be considered open to trade. And so countries relatively close to trade have larger multipliers, but open to trade don't seem to have as much because an increase in aggregate demand might be met by a reduction in net exports rather than by an increase in domestic production. So, I mean, this paper is purely empirical, but they try to come up with some idea of why that might be the case. And so when you're open to trade, then there might be some leakages because net exports might be moving around. The fiscal position of a country seems to matter as well. So countries which have high public debt levels, the multipliers are very small on impact and negative in the long run. And that just goes back to what we were talking about at the very beginning, that if public debt levels are really high and there's an increase in G, then it's even more, perhaps it's a signal that at some point or another, fiscal tightening is really, really required, right? And so then, it has to be the case, either G will go down very soon or taxes will go up really, really soon. And so then it doesn't have a very stimulative effect on output. So the fiscal position seems to matter, where high public level of debts are signal that multiplier effect of government spending on output is going to be very small relatively. And then one distinction that they make in this paper, which I think is very interesting, is that they also look at, they divide total government spending is government consumption and government investment. And so for a subset of countries, they can do that. They have quarterly data on government consumption and government investment. And what they find is that when there is an increase in government investment, that seems to have a larger multiplier, larger than 1 in the long run in developing countries. And so it's larger than the government consumption multiplier, and it's also larger in developing countries than in developed countries. So the composition seems to matter as well, that government investment, so government investment would be spending on infrastructure, those sorts of things, seems to have a bigger effect on output than government consumption. Another paper that sort of also provides international evidence, but a different set of countries, is this paper by Cray in the QJE from 2012. So Cray actually is at World Bank, and so he must have all this data. What he uses is fluctuations in World Bank financing for projects as an instrument for changes in government spending in 29 low-income aid-dependent countries. So most of these were sub-Saharan African countries. I went and checked the list of the countries. So this is from 1985 to 2009. So there, why would this be a good instrument? So borrowing from the World Bank finances a substantial fraction of government spending in these countries. So in that sense, the fluctuation in spending on World Bank financed projects are a significant source of fluctuations in total government spending in these countries. And then the spending on the World Bank finance projects is typically spread out over several years following the original approval of the project. So when the actual spending is realized, that was approved a while back when the state of the economy was whatever it was. So when G is actually going up, it is not correlated with the state of the economy at that particular period in time, because it's just committed, right? The project is going to do whatever. In the meantime, if you run into bad times or good times, you're still going to be doing that. So that gives you this, it helps you deal with this issue that the change in G should not be a function of the current state of the economy. And then Cray uses these World Bank project level disbursement data to isolate the component of World Bank finance government spending in a given year, and then looks at what is the effect on GDP. And he estimates multipliers of about 0.5. So for $1 increase in government spending, GDP is going up by $0.50. But it's estimated fairly precisely, even though, he's using annual data, but yeah. Maybe a little bit more relevant is his follow-up paper, where this was focused on 29 low-income countries. He increases the size of the data set to have 102 developing countries for a longer sample as well, from 1970 to 2010. And so it's not just World Bank lending, but it's lending by different official creditors. So these are just development banks and so forth. And he uses the similar reasoning to earlier papers. So here, if you look, these are the lenders that we're looking at, African Development Bank, Asian Development Bank, Asian Development Fund. So lots of these multilateral creditors and some bilateral creditors as well. And then if you look at, so those are the lenders. If you look at how the disbursement plays out, this is the average disbursement profile. So some share, about 20% of them, are spent in the same year that they are approved, but most of the spending is happening a year out, 2 years out after the loan commitment is happening. And so this is giving him the fact that it's not correlated with the current GDP. And then if you look at the countries that he has, 102 countries, so there is Pakistan there. So it has over this whole sample period, 18.4% of the disbursement, the ratio of disbursement to government spending. So this is capturing, significant variation in total government spending is the point made by these large numbers. And so with this data and using that same approach, he finds that the government spending multiplier is estimated to be around 0.4. So again, less than $1, less than 1. Okay, so I'm ready to conclude. I hope I have convinced you all that we need good theory and good econometrics to get a reliable answer to a question like, how does government spending stimulate the economy? What are the macroeconomic effects of a fiscal policy tool like increased government spending? And more evidence suggests that it's probably below 1. But it's not one number. It depends. It depends on whether we're looking at developed countries, whether we're looking at developing countries. It depends on recession, expansion, state of the fiscal position. So there is a lot of nuance there on, but that is also a sign of progress that we have made as macroeconomists in tackling this question. But I understand that government spending as a stabilization tool to stabilize, GDP might be also a privilege. Like if we look at the correlation between cyclical government spending and real GDP, this is from a Brookings paper that I found from 1960 to 2009. In most industrial countries, this correlation is negative. So they are running counter-cyclical. Overall, it's counter-cyclical in the sense that government spending seems to be used as a stabilization tool. But in a lot of developing countries, and so Pakistan is right here, the correlation is positive because when there are good times, you spend more. And so there is not as much room for government spending as a stabilization tool during recessions for various institutional reasons and some of the things that the Vice Chancellor touched upon in the introduction as well. So that's all I had, and I hope I inspire some young students to work on fiscal policy issues as well. Thank you.
And thank you, Professor Zara, for Zubairy, for an excellent presentation and also highlighting the role of especially initial endowments and the economic situation of the country, how the decision would reflect and how the government spending would contribute to the overall economic prosperity and GDP. So let's turn to the audience then Atar Ahmed. Atar Saab, please go ahead. Then Sadia Rana. Atar Saab.
Okay, thank you very much. This is Atar Ahmed. Madam, thank you for very useful and extremely scholarly paper. It was pleasure listening to you. I probably have missed the point. It is my weakness. So I need a little bit of clarification from you on that part. And then there is a very small question. Again, probably you can clarify it. The point which I missed was you talked about different estimation methodologies. Your results are robust in terms of use of estimation methodologies. I missed on that. What were the methodologies and your identification schemes? You talked about two. One was Blanchett-Perotti, I think, and the other one, I missed it. So if you could just explain what were they. And secondly, the small concern that I have, that fiscal policy to have an effect, it requires that there should be frictions in the system. And frictions could be both in the real sector of the economy or in the monetary sector of the economy. But as you know, and we are all familiar with the fact that in developing economies, these frictions take enormously different shapes and sizes and etc. etc. How to standardize data for these sorts of frictions to have a meaningful analysis? Thank you.
Okay. So I don't know, maybe I should share the slides again. So just briefly, I think I'm sorry that I wasn't clear, or I was
No,
maybe
it was my fault.
rushing
No.
through stuff. The methodologies, I guess maybe you don't need to worry about it. I use VARs or local projections. Those are the types of methodologies. Identification, I think, is very critical. And so
Yeah.
the most popular identification scheme that we use in the US, and it's very unique to the US, that's unfortunate, but it's based on this military news approach that how much do we expect defense spending to increase when some geopolitical event happens outside in the world, because then that's totally an exogenous increase in government spending. So that's one identification methodology. And then the other one is the Blanchard-Perotti identification based on the fact that government spending has legislative and implementation delays. To your point about different frictions in different contexts, developing or developed, I think, if you, for instance, read these papers by Cray as well, I think the big challenge is just establishing what the effects are, and then understanding these frictions, I think, is part of understanding the transmission channels. So even in his work, like when he's working, he finds these multipliers. They're kind of low in these developing countries, like 0.4, where in the US we found much higher, 0.7, 0.8. And then the question obviously is why, right? So it might be because of the types of frictions that you're talking about. And so when we're doing just aggregate analysis, we might or might not be able to come up with a really good story unless we bring in more data. So maybe we bring in cross-sectional data, or like maybe some of the firms are seeing higher levels of employment than others, and these sectors have less liquidity. They have less borrowing constraints. They can actually go and borrow and build, when public investment goes up. So either you'll need more data, or you will need a structural model to understand the transmission mechanism. So what you're alluding to is a challenging problem, and so depending on what question we're asking, we would need to do additional work. What most of the studies that I've highlighted here are doing is the first step of establishing, the big headlines of, okay, when we have an increase in G, this is what we see in output, taking care of, some of these identification issues or anticipation issues or different types of issues that we think are econometric problems. And then once you get these macro facts, then yes, understanding why this happens and, why is the number low or high, or what frictions might be playing a big role. I think that's where a lot of us are working. That's why there has been a great rise of micro data and macro as well, to understand what sectors are disproportionately affected, and to answer all, who are the consumers whose consumption is affected most, and that's where a lot of the literature actually is moving forward.
Gee, thank you, Sarah, for a great. I'm sort of kind of out of this literature, but nevertheless, one thing that's always puzzled me about fiscal multipliers is that we seem to be estimating a linear kind of thing. You talked about a bit of non-linearity, and I used the estimate of 0.4. Reflect on what Pakistan should be, given what the multiplier for Pakistan should be, given the fact that we have all these problems of governance, of corruption, and of the fact that we don't know, and of obviously of debt. We've got a huge debt issue. We've got several fund programs that we have. In fact, we've had a fund program throughout our history, and we failed in all of them. Would that matter? Would we still think that our fiscal multiplier is 0.4, or would that be much lower than 0.4? And could it even be negative, for example? We looked at the fiscal, the public investment, and public investment doesn't seem to have much of a return. It's really probably like digging trenches. So please reflect on that. What would the literature say on this? Thanks.
We have the data we have. So obviously the number that Cray is getting is an average over time across all these countries. And so it doesn't really inform us very well about individual countries. So, I mean, I think he's using annual data. So using that data itself for only a single country probably would not give us
he's also not using country characteristics, like, for example, corruption or the governance issue or the ability to spend.
Yeah, so he might have country fixed effects, which might or might not take care of some of those issues, but certainly not. Yes. So that's why I think good data is always very useful. So, I would not want to speak. I have not looked at Pakistani data myself, right? So I don't know if there is quality data available to look at that. And of course, there's going to be a lot of heterogeneity, and some projects maybe have a bigger effect than others. But it tends to be the case that when, our models also seem to suggest that when you have low level of capital, then an increase in productive capital, right? So that could be public capital can have a bigger boost than in a country where the capital stock level is high. So those theories would seem to suggest that there is room to have a stimulative effect of, let's say, public investment, if it is, if the elasticity of output to that public capital is large enough, that potentially has the potential to raise output. But it is possible, like we saw in the other study, like the multiplier can be negative because there could be crowding out of consumption and crowding out of private investment as well, right? So even in the US, like when this whole infrastructure bill was rolled out, a lot of discussion was whether public infrastructure spending might crowd out private investment, right? So those effects for sure, so multipliers can be negative. So I don't know necessarily in the case of Pakistan how we would tackle it, or you probably are much better better equipped to answer that. But theory seems to suggest there is room with public capital or public investment, more so perhaps than public consumption. And then, yeah, these issues of corruption, those kind of go back to the previous question about frictions as well. Most of our models don't have them. And so you would need specific, institutional knowledge to see if there are ways to control for that in the data. Again, I think those are challenging questions. Yeah, I don't know if I can say anything more that is more useful than that.
Yeah, thank you. There is like one thesis at PIDE that probably look into this question of how the institutional framework. Dr. Simon is there, so she did a thesis on that. How the institutional, the factor and also the different level stages of development would have some implications for the effectiveness of the fiscal policy. And one of your graph where there is a very sharp difference from the 0.6 positive in the one region to a minus 0.6 in the other region. So as Dr. Nadeem also mentioned, these factors have some implication in terms of reversing the factor. But the question, how we can regain the effectiveness of this fiscal policy? Let's take question.
Yeah, thank you, Professor Sara, for a very nice presentation, really summing up the debate in terms of the fiscal policy effectiveness. And the general conclusion is that it's not a 1 + 1 = 2 situation. There needs to be a lot of qualifiers before we can actually say that the fiscal multiplier is positive. Now, my quick comment, or you can maybe expand it more for our understanding. We also also now have hypotheses such as the expansionary fiscal contractions as well in many countries. And on top of that, when we look at the countries, then as Dr. Nadeem and later Dr. Nasir rightly pointed out, that there are many other characteristics which needs to be seen from that perspective. Another important aspect in the fiscal multipliers is the short run versus the long run, and you must have gone through the Romer and Romer paper as well, because there are different results. Even if we find smaller multipliers in the short run, may have eventually some better results if we look at the long-term perspective. So from that context, where do you find the very nice balance or delicate way to move forward, that how actually we can think of having a positive multiplier? Should it be a kind of an unanticipated shock always, because the agents might be Ricardian in nature, so they are anticipating something to happen, so they are going to quickly change? So it should be something which is unexpected, or it can be related to the quantum of the impact and other things. But on top of that, can we actually absolve the government from not responding to these economic crises as well, like we have seen in the case of 2008, or more recently in the case of Gov't? Can government really take a step back in terms of saying that, look, our multipliers are not positive, so sorry, we cannot respond to such economic situation? Thank you.
So yeah, you raised a lot of interesting points. So on the long run versus the short run, for sure, I think that is also one of the qualifiers, as you would say, that when we're thinking about the effectiveness of fiscal policy, what are we interested in, short run effects versus long run effects? Today, I talked a great deal about these government spending multipliers. You know, there's a parallel literature on the tax multipliers. The multipliers are even larger than one, at least for the US. I know less about the international evidence, but what we tend to typically find is that, you know, government spending multipliers are larger on average in the short run, but tax multipliers are larger at longer horizons. So if you're thinking about spending versus taxes as a tool, we should expect to see their effects at different horizons. Even within government spending, if we look at government consumption versus government investment, government consumption seems to have short-run effects, whereas government investment seems to have long-run effects. So the multiplier for government investment tend to be larger at the long run, and the multipliers for government consumption seem to be larger in the short run. So, so from a policymaker's perspective, if they want a quick, stimulus, what should they be doing? Versus if they are more interested in growth, what should they be doing? I think that is related to these short-run versus long-run multipliers. And there it seems government investment plays an important role. So, I think slowly, the literature is realizing all of these different nuances, different characteristics. And so with high public debt level versus low public debt level, or, exchange rate regimes. So I would think that slowly, maybe as we have more data, we might be able to come up with a more nuanced story about some of these other institutional details about country-specific effects as well, related to institutional details that you talked about. I don't know if I addressed everything you said, but I think we all understand all of these issues involved. We've made progress in certain dimensions, and then there are a lot of dimensions that you all have highlighted that there is still room to be done. And that is something I find interesting about this fiscal policy literature, that there's still so much that we don't know. And so for me, for young people, there's still much work to be done.
I think the other important component when we talk about the other factors, especially the institutional factor, they are very much persistent over the period of time, and the fluctuation is very low. But on the other side, when we talk about the policies, especially fiscal policy, it's very like cyclical in terms of the changes, and it have a lot of implication with the events, as you mentioned, in terms of the news events, the similarly other like that. So like the figuring out the implication of those fundamental factors would be hard with a very like a small time series. For that, you need a very long data set to come up with some concrete set. So Muhammad Salman, please go ahead. Your question, please.
Assalamu alaikum.
Yeah.
This is Muhammad Salman, and I'm grateful for, from my part, that you have delivered a very good presentation and about the topic. My comment plus a question is that being economists, we are getting used to looking at different problems the countries are facing only from the lens of macroeconomics. But when it comes to the practical side, you can see that as the world has become a global village, there is an interdisciplinary blend going on. What do you think that shouldn't we be studying the problems not just by taking a macroeconomic variable on the left side and the other variables on the other macroeconomic variables on the right side, in spite of getting data like the psychological impacts, like the regional impacts, like medical. I mean, there should be a studies going which could give us a more insightful like impact of the government spending or the fiscal policy or rather the control measures like macroeconomic policy. Thank you, ma'am.
So I think in recent years, one of the things that we have seen is that there has been an increasing interest in inequality, right? So I think that you could link to sociology or just, you know, bigger, broader questions of bigger, broader themes, right? Where that as macroeconomists, yes, I focus just on GDP, but there is a growing literature on looking at what are the impacts of these policies on inequality. Are they making certain segments of the population better off at the expense of others? And so I think there is a movement to understand broadly more disaggregated effects of these policies as well. But again, you know, data is always one of the things that might hold us back. So I know, you know, people at IMF have looked at lots of cross-country studies with the effects of fiscal policy or monetary policy, and maybe the Gini coefficient or some other variable like that to capture inequality and look at how that affects different people's lives. But yes, to look at it at a very narrow, you know, to answer your specific questions, then we might also look at case studies, like how did the rollout, and that's what a lot of applied microeconomists do, right? That when you roll out a policy, a specific policy, how did that impact people if you have a nice control group as well. But I take your point. I think we want to answer important questions. To go back to Dr. Iqbal's point, you know, like some of these country-specific characteristics are very persistent, and that's why I think that dividing samples is one way to go, right? That, okay, an exchange rate regime or level of development is a persistent factor, right? So then if you have similar countries, then maybe that you can get some power by grouping those particular countries together. And then I remembered, like, one of the other questions was talking, and Dr. Iqbal touched upon as well, like this discretionary policy as a tool during stimulus. You know, one of the other issues that we're facing, I think we are maybe facing it around the world, is this question of fiscal sustainability, because so much of fiscal policy is actually tied down. So, for instance, in the US, so much of it is tied down by entitlements, Medicare, Medicaid, like spending on Social Security. These are commitments of the government to older people, right? That nobody's touching, and then people just fight over that really, a small share of discretionary government spending on what you should do or not. And then all of these fiscal sustainability concerns with demographics, with aging populations, low fertility rates. I think, in the fiscal literature, that is one of the other things that we are going to be grappling with. Yes, what we've talked about today are these short-run effects, right? How can we use this policy as a stabilization tool? But that's when we have room to do that, and not when our hands are tied because of these other commitments. And I know, like, I work with economists at the Inter-American Development Bank, and in Latin American countries, they have like very strict fiscal rules and then lots of fiscal commitments. And so that gives less and less room for these types of discretionary policies. So that is another, elephant in the room.
Let's take next question.
So my question to you, plus a comment, would be that since you've mentioned that government investment spending has a positive impact on, has a positive multiplier in the context of developing countries, but don't you think, like, for developing economies, they often at times, they call it investment, and surely it does. I mean, look at infrastructure. Look at the infrastructure spending that they do. They often over or under allocate resources that might be unproductive in a sense. So how could you say that this obviously this would require a further breakdown of government spending in the infrastructure sector? And then I understand, but don't you think, like, this number, like a positive number, it could be an overestimation? Obviously, it requires more data. Since you've mentioned this.
So actually, there are a bunch of papers on infrastructure spending, more related to the highway networks, for instance, in the US, and there they exploit variations in the formulas for allocation of highway spending by the federal government to the various states. And those are, those are exogenous in the sense that they're not a function of the state of the current economy. And they find significant multiplier effects of that type of infrastructure spending. Now, if you discuss, telecommunication spending, like, we want internet in rural areas versus, so that, okay, sure, I don't know if that has the same size of multiplier, but there seems to be very nice, clean econometric studies done to look at the effects of infrastructure spending in terms of highways for the US, and they seem to have a stimulative effect on the economy.
Yeah, related to my earlier assumption that the other factor would have some implication, though there are two different narrative. One is the quality of institution, and other is the institution itself. Like a big example is either it's a democracy, either it's autocracy. Those have a different stream. But on the other hand, we have to look into the quality of those institutions. Look at the example of China, look at the example of other countries. They have a very different set of institutions, but the performance would be totally different if we compare to the one aspect of the similar related to the fiscal policy. Whether it's the quality of fiscal policy or the size of the fiscal policy, what would be the key factor in terms of determining the overall, the implication of this, especially the multiplier and something like that? How the literature would guide us in terms, especially this is very important for developing country like Pakistan, where we have this two type of issue. On the one side, maybe the size of the fiscal policy is low. On the other hand, we are struggling with the quality of the fiscal policy, maybe in terms of the allocation, maybe in terms of its implementation. How the literature will guide us from which would be the key area for us to focus if we really have to get something from the fiscal policy?
I mean, you ask very difficult questions. So as far as size goes, so that is something that also the literature has started looking at recently. And I mean, there, at least in theoretical models, like first, if you have just linear models, the size doesn't matter. Like the first dollar has the same effect as, you know, the $100, for instance. Once we start looking at nonlinear models, so in nonlinear theoretical models, and this is something I worked on as well, in these models, especially if the spending is happening during bad times, then that first dollar has a much bigger bang for the buck than, you know, as you keep increasing. So the initial spending seems to have a much bigger effect, but this is if you're in bad times. If you're in good times, then there is not much distinction between the small package versus the large package, that the marginal returns are not decreasing if you're in an expansion. So the state of the economy is also a relevant dimension when we're thinking about a small package versus a large package. But I think the more important thing is what you touched upon, which is the quality of, you know, or the composition or the allocation. And there, you know, again, I know the literature more from the advanced economy side. There seems to be a suggestion that government investment is more productive or has a larger impact than government consumption. And then within that, you know, I wish we could learn more, but, you know, like, as I said, one study I know about is about highways. But there too, theoretical literature seems to suggest that when your capital stock is low, then, you know, increasing that capital stock has a bigger return. But what the optimal level of there's a whole literature on that as well, right? Like what should be the optimal level? But again, optimal stuff might be too far away from reality. So that's why we start with these empirical studies to see what we find in the data now. But I think, yeah, obviously the quality of projects matters a great deal on the rate of return. And then it's also going to be a function of the needs, right? And so what are the needs? Like where is there room to make the biggest impact?
Thank you so much. I want to ask one thing that, as my colleague said, Azhar, that government mostly invest in the vague things we have, but shouldn't we incorporate the individual agent while seeing the multiplier effect? Because we see that in the government expenditures, the main thing which lies in is the individual agent. Now, how individual agent lives, like their societal issues, their psychological issues, their behavioral issues. So should it be possible in the case of countries that we should see the multiplier while seeing individual agents' behaviors?
So whenever the multiplier, for instance, is less than 1, what is happening is, you know, Y equals C plus I plus G plus net exports, right? So if output is not going up by $1, when G is going up by $1, that means either consumption is falling or private investment is falling or both are falling. So typically we find that private consumption seems to be crowded out. But then there are studies now looking at the cross-section, like whose consumption, like what is happening to consumption across the income distribution, based on their balance sheet. And so we tend to find that the consumption of the lower income agents seems to go up, and the consumption of the higher income agents seems to be crowded out in response to an increased government spending. So we are getting better and better understanding by using you know, survey level data on consumption and income to get at who, you know, at the household level, who is benefiting or whose response is going in which direction, who is working more as a result of that, or who is consuming more. And so there we have I think we have a better understanding now than perhaps we had maybe 10 years ago. But most of these studies that I know of are related to the advanced countries, not so much the developing one.
Over the last, especially the financial crisis and the most recently this COVID give a new thinking to the entire fiscal policy. You know, we have a lot of emphasis on the stimulus packages, and you have a lot of work on the US and you study how the stimulus package would work. And I was just reading a couple of articles on this. One is, it's not about like they primarily talk about the technology. It's not about the available technology. It's the use of the technology, how much we are using this technology, and the effectiveness of technology depends upon the other part of the economy, the other infrastructure component, maybe the social capital, maybe the physical capital, maybe also the institutional capital as well. Where do you feel like the thinking is now going, like heading toward the role of fiscal policy in terms of the future economy? Because if you look into the growth projection by the IMF and other institutions, we might have like a recession in next like a few years, depending upon the recovery, especially from this Russian war and also the Israel-Palestine war, and also to some extent the election year. So where do you feel would be the future of these economies, especially when we're looking into the most of emphasis on the fiscal policy, one on in terms of the stimulus packages, and the two in the name of social protection, because the social protection is some sort of the stimulus or the subsidy to the general public. So what are the ingredients, especially for developing country, where we have to focus if we're really looking for the future in terms of the recovery?
So, that's a very good question. I think during COVID, everybody did whatever they needed to do to respond. But now that the dust has settled, I think the big looming thing, and it's a problem for a lot of countries around the world, is something I touched upon earlier, is fiscal sustainability. Public debt to GDP levels, even in advanced countries, are at unprecedented high levels. In the US, like, this is, as maybe World War II was the only time period. We're at an unprecedented high level, right? So then if we are again in a situation where there's a recession, I think there will be a much more hesitation to use fiscal policy as a tool when you have such high level of debt to GDP. And then a lot of it is just because of our commitments. And then the other thing that has happened in the last few years, interest rates have gone up. And that has a big impact also on the developing countries. US dollar has become strong. That has an impact on the developing countries. And so I think there's room to wiggle and to use fiscal policy as a tool. So unless interest rates start falling, the dollar depreciates, given the current circumstances, I think if something were to happen, tomorrow, there is much less maneuvering room for fiscal policy than we had in the past. But so I think the situation is quite different, because the starting point then was also different, that we didn't have very high interest rates. And so, yes, so I think the situation is a little bit more precarious, and let's just hope we are not hit by really bad shocks in the near future. But I think one of the issues, you were talking about Pakistan, even in the US, because these political cycles are just so short, politicians don't necessarily have the incentive to act. Like, here too, we're making all this noise about fiscal sustainability, or, high debt to GDP ratio. Okay, as far as you were saying about social protection, sending money to Ukraine or whatever else, there's a little bit of disagreement going on now. And I think they can use fiscal pressures as an excuse. But at the end of the day, I think politicians' incentives are not quite aligned to think about these long-run issues, because they work on such short cycles. And so then the thing that always suffers is fiscal policy, because that's set by the government. But I don't want to end on such a negative note. I mean, there are lots of questions that we can study, and hopefully, having these discussions helps politicians be a little bit more aware of the issues we're facing, and so that we see action.
Yeah, thank you. At PIDE, we are like talking about the fiscal policy and also the reforms, and we are suggesting various reforms. And Dr. Nadeem is working very hard to convince the politicians and other public officials to let's listen us where we are and how we can at least make the existing resources more productive and how we can maximize the benefit from the existing. It's not about, as I earlier said, it's not about the pie. It's the how we use the existing pie. That is also important, especially for the developing country. With this note, I must thank Professor Sara for your time and enlightening us in term of learning more about the theoretical perspective of the fiscal policy and also its empirical contribution. And especially our student must have like a deep insights how we can get a very robust result and the role of different methodologies in terms of making a convincing case for the fiscal policy. With this, I must say thank for your time.
Thank you. Thank you so much. Thank you so much for the invitation. As I mentioned in the beginning, for me, PIDE is the institution in Pakistan in forming policy and one of the best universities there. Thank you so much for the invitation. And this was a wonderful conversation where I think I also learned a great deal from you all. Thank you so much.
Definitely, we look forward once we have some funds, we will invite you to physically make some presentation at PIDE. Thank you so much. Take care.
Thank you. Bye-bye.